The basics of dividends are very simple. It's just the return of a company to its shareholders. Now let's say you own 5% of a coffee shop that makes a profit. Now my guess is that you'd like to see some of those profits coming back into your bank account. If you are a shareholder in a company, you own a share in that company and are entitled to some of the company's profits. Dividend payments are now determined by the board of directors on a per-share basis, meaning the more shares you own, the more profits you will see. For example, Verizon, pay attention to its dividend payouts and you will see two numbers, a dollar amount and another dollar amount, which is how much you will be paid per share per year. Now dividends are usually paid quarterly, so 4 times a year for Verizon. You can receive 4 quarterly payments of 64 cents per share, which equates to $2.56 over the course of a year. Remember that the dollar amount is fixed, but the share price is moving up and down every single day. If the share price goes down, then the dividend yield will increase, and if the share price goes up, then the dividend yield will decrease. Similarly, Verizon sold for $20 last year and the dividend yield has grown significantly. It is now trading at $59.53 and yielding 4.3%, which means its earnings per share went down to 20%. The dividend yield has gone all the way to 5.3%, meaning you can now buy more shares of Verizon and get a higher payout per share. Word of caution: remember that the board of directors of the company determine the payment of dividend. They can increase or decrease dividend payments at any time. Now, if a company is underperforming, one of the first things to do is save money and secure a business, is to reduce Boeing's dividend payout in 2022, all the way down to 28 cents again. If there is something wrong with the business and if the dividend yield could be at risk, watch and see. If the dividend yield is high, it may be unsustainable. A typical dividend yield is 1 to 2.5%, where 3 to 6% is very high but very durable. If a company is paying a dividend of more than 6%, it usually means that something is wrong with the business and that it is in danger of cutting the dividend again because it was paying 7 to 9%. The shares have been going down since 2016 because the fundamentals of the business were actually quite poor, meaning that all of your dividend payments would have been wiped out by the falling share price, and then eventually, the company would have to pay dividends anyway. First, stick to the range from 1 to 6%, where you know there could be something going on with business. Secondly, the best strategy for dividend fundamentals are here, and you can find your dividend stocks to invest in and build a dividend passive income portfolio. The third is growth profits, so look again at our good friend Verizon. The company was paying a dividend yield of 5.3%, as it tends to change over time. They have consistently paid and increased their dividend payments for the past 18 years. With these 3 key pieces of information, their 3-year growth rate is now 2%. This assures that the company Verizon will distribute good dividends and continue to pay out for many years. Increasing those payments over time reveals which dividend stock is the best. Actually, if you buy 2 dividends, screen them or work on the list that has already been created. If you want to find dividend stocks, go to finvest.com and go to Screener and then select Filters, Country, USA, Market Cap, over 2 billion, Dividend Yield, over 3%, Average Volume, over a million. Next, go to the Financials tab, filter by market cap from highest to lowest. This will give you a really solid list of some of the best companies in the United States that yield over 3%. Pick some of the best stocks of your choice by going through this list, and if you want to go the slower route, I don't blame you at all. There are many others in the world who want to go the slow route, so 2 fantastic lists were created: the Dividend Aristocrats list and the Dividend Kings list, which can be considered as 2 exclusive clubs. To get on the Dividend Elite list, you need to meet very strict criteria. First, the company needs to be on the S&P 500, which has 25 consecutive years of dividend payout growth and has a market cap of $3 billion. It really only leaves a handful of companies that can be listed, but the Dividend Kings list is a step ahead. To get on the Dividend Kings list, the company needs to meet all the requirements of an elite list, plus 50 years of consecutive dividend growth. These are the most sought-after dividend lists, and the companies have to be the best of the best to make it on these lists. This is a great place to start looking for dividend stocks. Now you have the best dividend portfolios in the history of the world to do some dividend hunting. There are many ways we can invest in dividend stocks, but the 3 most popular ways are simply buying stocks, buying dividend ETFs, and then buying rates to save you a ton of time. Hope you enjoyed the video. Check out our other videos. Don't forget to like and subscribe. See you soon.